Okay, so here is a wild one for you. An autonomous driving company finally posts its first ever quarterly profit, but they didn't make the money on the streets. They made it playing the stock market. Welcome to Earnings Unscripted. It is March 26th, 2026, and today we are looking at Pony.ai, ticker PONY, and their fourth quarter 2025 results are just, well, a bit of an illusion.
Yeah, it is absolute financial magic. They booked a positive net income of $75.5 million, a massive swing from a big loss last quarter, which looks incredible on the headline until you actually look under the hood.
Right, the trading gain.
Exactly. It is entirely driven by a $132.5 million paper gain on trading securities. Underneath that, their actual operating loss worsened to negative $73.9 million.
A robotaxi company moonlighting as a hedge fund. And just a quick reminder here, this show is purely our personal opinions, not financial advice, so please don't let our podcast manage your portfolio. But Miro, the market completely saw through the illusion, didn't they?
Oh, entirely. The stock was sitting around $11 right before the morning call. Then the regular session opens and it just faces this sharp early sell-off. It broke all the way down into the mid-nines and closed the day down nearly 11% at 972.
Geez, a double-digit drop on technically positive earnings. But let's be fair, the top line was actually decent. Total revenue hit $29.1 million, so that is roughly 15% growth quarter over quarter.
Sure, the top line is growing. The problem is the mix. Gross margins compressed from 18.4% last quarter down to 12.7%. They are pushing hard into robot truck services right now.
Which brings in revenue, but hurts the margins.
Right. Robot truck revenue jumped to $13.1 million, but it's fundamentally a lower margin business compared to the taxis. So they are trading profitability for top-line velocity.
I get that. I do think the core tech deserves some credit, though. There was this crazy anecdote on the call about that heavy snowstorm in Beijing earlier this month.
The whiteout conditions?
Yeah! Human ride-hail drivers were spinning out and basically disappeared from the roads, but Pony's Gen 7 robotaxis just stayed online. They ran operations 24/7 through a blizzard and soaked up all the stranded order volume. I just love that detail. It's this rare real-world moment where the AI clearly beats human drivers in a physical crisis.
Mm-hmm. It is a massive engineering flex. I will give them that. Validating their world model in blinding snow is genuinely impressive. The tech clearly works, but, surviving a snowstorm and surviving unit economics are two very different games.
So true. But they also have a massive war chest now to figure the economics out. They raised over $800 million in their recent IPO, vaulting their cash pile up to $1.5 billion. All right, let's get into the details and what they actually plan to do with all that runway.
So the funny thing is, they actually do not plan to spend it on cars at all. That runway is just padding because their capital expenditure profile essentially vanished this quarter.
Vanished in a bad way? Like they just stopped investing?
No, in the best possible way for a startup. Their CapEx for the fourth quarter dropped roughly 71%, $6.6 million compared to nearly $23 million in Q3. And yet, they are publicly targeting their fleet to more than double to over 3,000 units by the end of 2026.
Okay, wait. You do not add 1,600 autonomous vehicles while cutting your hardware spend by 70%. The math does not work.
Right. The math only works if someone else is buying the metal. And that is exactly what they're doing. Leo Wang, the CFO, called it their joint deployment model. He explicitly said they are essentially in the asset-light model now.
Ah, so they're just passing the hat to the automakers.
Exactly. Partners like Toyota are stepping in to fund the actual physical vehicle CapEx. So let me phrase that better. Pony provides the software, they take the autonomous driving kit fees, and then they share the ride revenue. They completely eliminate the initial balance sheet bleed.
Wow. That changes the entire unit economics logic. I mean, it's one thing to be a taxi operator buying depreciating cars, but if you're
just licensing the brain of the car to Toyota, that's infinite scale, assuming you get the software right.
Assuming. Yeah, that is the operative word. And this is where I start getting very skeptical because management is heavily leaning into this hypergrowth narrative. Wang even said on the call they're confident robotaxi revenues will at least triple this year.
Triple? Okay, but if you have thousands of partner-funded cars hitting the streets globally, tripling the top line does not sound completely unhinged.
It sounds reasonable until you... Actually, no, just look at the sequential numbers. Yes, year-over-year growth sounds amazing when you start from a low base. But from Q3 to Q4 of this year, robotaxi revenue was completely flat. Actually, it shrank slightly. 6.66 million, down from 6.69.
Really? Flat? I completely missed that because they were screaming about hitting peak daily orders in Shenzhen. I think they cited 25 orders per vehicle per day.
That's exactly the discrepancy. You have paid orders supposedly surging, utilization hitting peak records, and your quarter-over-quarter revenue literally flatlines. What does that tell you?
Fares are dropping, or promotions. They must be subsidizing the rides to keep the utilization metrics up.
Has to be. They're clearly hitting the ceiling of what consumers will naturally pay for the current geographic footprint. Classic supply and demand. You can show investors huge order volume, but you're buying those users.
It feels very much like the early Uber days. Subsidize the rider, juice the engagement, show Wall Street the volume. So, if the top line is stalling sequentially right before they supposedly triple it, where does this leave their actual operational trajectory heading into next year?
It leaves them betting absolutely everything on geographic expansion. Look, you cannot squeeze more margin out of the current footprint if pricing power is already maxing out. So they just have to scale horizontally.
Right, which perfectly matches their guidance. They are explicitly projecting rapid expansion into more than 20 cities, and with IPO cash and Toyota rolling out the hardware, the CEO sounded genuinely confident about blowing past that 3,000 unit target by the end of 2026.
He did. But the real structural risk here is not just... Actually, no, it is not getting the metal on the road. It is whether their software moat holds up. There was a lot of chatter on the call about open source AI models, essentially commoditizing the driving intelligence itself.
Oh, but the CTO completely swatted that away. Tiancheng Lu literally said an open source model is a good starting point, but not the end product. He's basically arguing there is a massive reality gap between downloading a generic model and safely operating a commercial robotaxi fleet.
Yeah, and to his credit, he is absolutely right. Simulating a drive is easy. Real-world entropy is brutal. I mean, they recently dropped their test cars directly into the ancient narrow streets of Zagreb in Croatia. You do not just deploy into an old European city core if you're faking the underlying tech.
So it feels like they are finally graduating from a neat science experiment to a pure logistics machine. They survived the R&D phase, they survived the Beijing blizzard, and now they just have to survive Wall Street's growth expectations.
Pretty much. And ideally, maybe start generating their profits from actual passengers instead of paper trading gains.
Okay, yes, very fair point. We'll definitely be watching to see if the street fares can actually overtake the stock portfolio next quarter. If you want these earnings breakdowns to just show up when you need them, you might want to follow the feed. Also, just a quick reminder that this podcast is generated with the help of AI tools, which is exactly how we can process hundreds of pages of financial filings in record time. We would love to know what tickers we should pull apart next, so email us at earningsunscripted@datamadness.ca or find our X link in the show notes. Talk to you soon.
Catch you later.